Hey everybody, welcome back. This is something that you guys have been very interested in since I started doing my MicroStrategy options videos. And a lot of you are hungry for my approach to trading options. So I'm going to start with the very basics. This is going to cover calls. And let's just jump right in real quick. So I'm going to call this Options 101. It's going to be part of a longer series. And I'm going to go deep all the way to the type of stuff I do now. One thing I want to recommend is I've been doing this for 30 years. So this is an area where I feel very comfortable. I hope I don't lose anybody here. I'm trying to make this as simple as possible, but I want to show you all of the tools that I use when I make investment decisions and how I use covered calls actually myself with a real life example. So first of all, covered calls, I like them because they're very low risk and very easy to do. Now I'm going to show you exactly how I approach this whole area. The other thing that I want to mention too, which I find very exciting, is we all know that a Bitcoin ETF is coming. And what does that mean? Well, I'm going to show you a covered call trade that I do with my whole trading thesis and my approach for another ETF called JETS. And we can apply that same type of methodology to a Bitcoin ETF when it comes, because when an ETF comes, so do call options. Now, many of you ask, why do I not trade futures from the CME on Bitcoin today? And that is because the spreads are so crazy. I just can't find ones that actually work for me and my appetite. The pricing is just off. It's not fully baked. But as these markets mature, it'll get better and better, and we will be ready for that. So take this as a time to prepare and learn and do paper trading and many other things as we go forward. So as I mentioned as well, I'm going to show a real life case of how to make 103% on your money in 120 days and how I did it with the JETS ETF back in November. Now, a few things before we jump in. This guy is Mr. Munger from Berkshire Hathaway. I don't agree with some of his trading theses today. However, he did say one thing, and that is a concept called inversion. It's always good to buy into weakness and sell into strength. You know, buy low, sell high. And that's exactly the premise that I want you all to think about as well. I want you to always think as well of yourself on the other side of the trade, because if you don't sit in those shoes and understand who is on the other side, you will never be successful. Remember, this is also a zero-sum game. So for every winner, there's a loser, and 90% of options expire worthless. Think of that very carefully. 90% of options expire worthless. So do you want to be in that 90% or do you want to be in the 10%? Therefore, always think inversion. And I'll show you how I approach that as well. So call options. I think many of you already know what call options, but they give the buyer the right, not the obligation, to buy a stock or bond or a commodity or any other asset or instrument at a specified strike price within a specified period of time. There are leaps which go out 1+ years. Some of them are out 2 or 3 years. And I actually bought some leaps back about 2 years ago on Tesla, which did very well. Now, it's also important to remember that a call buyer profits when the underlying asset increases in price. So another way to look at that is with a chart. So if you imagine a $10 stock with a $10 strike, and you sell that call option for $2, this is what your profit line looks like. If you are owning the call option, as the share price increases, so does your profit. However, if the share price goes beneath your strike price, your call option becomes worthless. And that's very, very important to note. But there's a few little benefits from that as well. If you are buying a $10 stock that goes to zero, you lose $10. If you're buying a $2 call option on a stock that goes to zero, you lose $2. So there are plus sides, and that's a big part of the risk management play of options as well. So that's just call options. It's important to have that background before we jump in. Now, a covered call strategy means you buy the stock. For example, you have to buy everything in multiples of 100 shares because a contract is a function of 100 shares. So you buy 100 shares and you sell one call contract. Or you could buy 1,000 shares and sell 10 call contracts against your position. And it's always good to sell an out of the money position when you are selling these calls, or very close to being at the money, but never in the money, unless you really believe the stock's going to go down, but then you shouldn't be in that trade anyway. Now, this all sounds very complex and boring, but it'll make sense when I show you the real life example. So please hang in there and look for that actual real life trade for where you can make 103% in 3 or 4 months pretty easily. So a covered call strategy, again, think of a $10 stock, $10 strike, $2 premium. You can see that your profit is very quickly capped as the share price increases. And that's very, very important. And your break even becomes $8 because you buy the stock for $10 and you sell at $2 in premium. So you can actually ride that stock down to $8 and still be at break even. And that's very important as well. So it's attractive from a multitude of different perspectives. Before we go into the actual real life case, I want to go over some key things. One is the math to make sure you guys all understand things like margin. One of the beauties of covered calls as well is the fact that you can buy stock on margin. So you can buy 100 shares of a $10 stock on margin, which means you only have to put down $500 in cash and you borrow $500. And if you're doing it for a short period of time, the interest is actually very, very low. So you could sell the $10 calls for $2, like I mentioned, 3 months out. The income's $200. If the stock stays flat, your profit's 40%, i.e., you put down 500 and you make 200, 40% return. If the stock goes up 20%, the profit's the same. Again, you cap your upside. And if the stock falls 20%, you're at break even. So it's like a win, and a break even. It's only if the stock goes down more than 20% is when you start to lose money. And that's what you would have lost anyway if you held the actual equity. So you're saving yourself on the downside, capping your upside. Now, there's a few other things that you need to know when you play with these options. And again, not a financial advice, but options are very, very dangerous. Remember, 90% expire worthless. So you don't want to be buying them unless you really, really know what you're doing. Knowledge is king. You need margin authority and you need options authority. So what is options authority? So there are different option levels within your typical brokerage account. You can do covered call writing. In fact, you can do covered call writing in many retirement accounts as well, and protective puts. You can do index puts and calls. You can do covered put writing, spreads, naked put and call writing. I do a lot of naked stuff. I do a lot of naked straddles and strangles. I'll introduce you to all of those later if there's an appetite for all of that. But again, for this, you have to make sure you have margin authority and level 1 options authority as well within your account. Now, the other thing that's very, very, very important is there's no such thing as easy money or a free lunch. So make sure you practice before you execute. Now, the rule of thumb is if you're new to this whole area, do what I call paper trading, and that is simulate an actual trade. So pretend you're going to buy a stock for $10 or $20 and pretend you're going to sell an option and simulate and watch it for a month and see how it does. And I don't want anybody doing this for real until they have 9 out of 10 of their trades are successful. And that sounds a bit draconian, but again, this is real money and you don't want to be losing. But when you practice, and you practice with paper money, it gives you an awful lot of comfort to be able to jump right in. Now I'm going to show some key tools as well that will help you be more successful as well. So let's talk a little bit about volatility. Volatility can be your friend, especially when selling options. So volatility or VIX, the higher the VIX, the higher the options price. The lower the VIX, the lower the options price. So if a stock is super stable, you're not going to get a lot of premium for selling them. But if a stock is super volatile or has a big bounce, it can really impact the price of options. But we're going to now jump into the real life case and how I approach an actual trade and how I believe you can safely make 103% on a trade in 120 days. Sounds like clickbait, but it's not. And I'll show you all of the tools in my tool chest to be able to do this successfully. So first of all, I like asymmetric bets. I like to have the odds stacked in my favor before I play. Very simple little graph here. I think you all know what asymmetric bets are. And remember, zero-sum game. For every winner, there's a loser. Which side do you want to be on? But to increase your probability of success, you need to use all the tools in the tool chest that I'm about to show you right now as well. So this is a quick graphic I put together, which shows you my approach to asymmetric bets. So you want to maximize your upside and minimize your downside. So you need to look at things like risk management, financial tools, technical analysis, hedging, arbitrage, which you all know I like to do. You need a lot of quant. You need to know your numbers. You need a very important rule as well that I like in investing is know your exit before you enter. Okay, and paper trade till it's automatic and have patience, wait for the right opportunity, and then do a lot of research, both macro research and micro research, and even down to the level of detail of an actual stock or ETF or index or anything like that. So if you don't have all three of these together, for example, if you don't do your research, you've got no edge. If you don't do your risk management, you've got high risk. And if you don't have any discipline, things are going to blow up. So think about that. You need these three cylinders, this three-legged stool to operate to be successful. The first step in any trade is to build your thesis. So for me, and this is the real life situation, so back in November, due to C-19, we all know what that is, and I don't want to get demonetized, so I'm not going to say the word, travel was dead. However, I was tracking a lot of the medical news around the vaccine, and there was a release on Operation Warp Speed from the Department of Defense that a vaccine was over 90% successful. And I was blown away by this success rate. And I knew with that type of success rate, airlines would start to come back probably in 6 months. And I thought this could be great for the airline industry. So this will happen on November 6th. My bet was travel will come back. My play was airlines. Could have been hotels or whatever else. I chose airlines. My target was the JETS ETF, which doesn't look at individual airlines, but a big basket of all the top airlines. And my technical analysis looked at the chart, and my quant examined the options. So that's kind of a thesis. And what I want to do is also with this community here that we have is share ideas. I know a lot of you may have similar type theses around Bitcoin mining, and I'm actually looking at similar plays for some Bitcoin mining cuts like Riot Mining and Hut 8 and others, and I'm putting all that together. So if anybody has any good information that would belong in a thesis, let's work together because two minds are better than one. Step 2, look at the actual chart. So this is the chart on November 6th. The price was about $17.44. The top was about $19. So upside was about 2 times the size of the downside. The bottom was about $16. So buying at 17 when the bottom is 16, not too much of a risk. But I thought the ETF would bounce because of vaccine news that was going to come out over the next month or so. Let's see what happened. Sometimes I don't expect things to move as fast. So I got into the trade on November 6th. That was a Friday. And on November 9th, JETS gapped open big time because of this vaccine news. It was just, sometimes the markets lag actual news. It takes people time to actually put together a thesis. But here we were. The stock went from 1740 all the way up to 21. The VIX, the volatility went through the roof. So I sold the March 2021 $22 calls for $2.19. And my cost basis now for the trade was $6.31. I'll talk more about that in a minute as well when we come to the review of the actual trade. The other thing that I like to do is I run my own Black Scholes models to identify market pricing inefficiencies. So I did this for the JETS ETF. I create one of these models with a whole bunch of different simulations for every single pricing to understand exactly where I should play, which call I should sell or buy based on pricing, based on what I believe the pricing should be, based on what it actually is. And believe it or not, the options pricing is often way off. For example, the MicroStrategy put options were completely overpriced. So selling them for over $100 when the stock was at the $290 strike price, when the stock was at $299 for $109 was just a complete no-brainer. And things like this model really, really help. The other thing I'd like to look at is I run a lot of simulations, sometimes 300 different simulations between a range of prices where I believe the stock has been, both downside and upside, and where it could potentially go based on my analysis. So I put in my range and I run random simulations based on volatility, and I get a whole series of prices, put and call option prices, and I use this tool as well to create an average so I know the range in which I want to play. And I use this heavily when I actually trade options on Tesla. Again, another tool, not everybody needs to use this, but it gives me that added level of comfort. Again, it helps me use a lot of data from my asymmetric bet. So let's look at the result real quick. So I bought at $17.44. JETS bounced to $21 based on the vaccine news, which was available a week earlier.
I didn't expect it to happen so fast, but there it was. The volatility went through the roof. I sold the March $22 calls for $2.19. And I sold my rights, basically selling that call. It means I sell my rights to sell the JETS stock that I own at $22. Now, what's really interesting here is when I went into the trade, say we were talking 100 shares, I had 10 contracts, which was 1,000 shares, but we just talk 100 shares for simplicity. I bought the stock at $17.44 times 100 is $1,744. Half of it was margin, so I only put down $872. So my cash outlay is $872, and I borrow $872. Then the JETS ETF bounced on the vaccine news. Stock went to $21. I had 100 shares, so the value of that was now $2,100. I was already up. If I had no margin and just bought the equity straight, it would have been a 20% gain just in 2 trading days, which is in itself good. But to show you the power of a covered call, I felt 22 was a good price, which was about $1 out of the money. So again, the stock was at $21. I sold the $22 calls for $2.19. I ran the numbers. I calculated the pricing, and it seemed like a very good deal in the marketplace. So I brought in an additional $219. So my cost basis now went down from $872 down to $652. I still owe the $872 in margin, so bear that in mind. So I will be settling this trade at $22 a share, including paying the margin of $872 back. So I make a net profit of 103% on my outlay of $652, i.e. I pull in $675. I hope that is clear, and I can, as always, share the actual models if anybody wants to see. The other question I typically get is, okay, what's the downside? We see how you made profit, but how could this whole trade go sideways? Well, I bought at $17.44. I took in $2.19 from selling the covered call. So my break even now is down to $15.25. And the 1-year moving average of the stock is $19. So it would have to take something really bad for this airline ETF to go belly up. And that could still happen. All of these airlines could file for bankruptcy, and I expect some of them may in the near future. But that's why I want to get out of this now. I do expect some turbulence, excuse the pun, in the market as we go forward. But using this little chart here, you can see the green line is the actual profit line, and 0 is exactly at $15.25. So if the ETF goes all the way to $12, I lose about $270 per contract. Conclusion: covered calls are great for passive income. You can get 5 to 10x your normal stock returns using covered calls as compared to buying the stock. You get downside protection. For example, the stock could tank 20% and you're still at break even, but you do cap your upside. So imagine buying 100 shares of Tesla at $200, and then you sell the $250 call and Tesla goes to $4,000 a share. That's a very sad situation. So there is other strategies. If something does bounce and becomes very positive, you can actually do a roll up, or sometimes it pays to actually just buy your call back that you sold short. And you can do these trades in both flat and bullish market conditions, but you need to do your risk management, quant, and your research. Very important. You got to do your homework before you go in. You got to have that thesis. You got to have the discipline. You got to have the numbers, the model, the technical analysis, the knowledge of macro and micro before you jump in. Hope this was helpful. First in a series. Please give me feedback. Let me know if it's too basic, too complex, or just about right. And I'll always do these cases with real life trades that I do to make it easier for people to understand. And again, share your ideas. Very interested now in the mining stocks. I know a lot of you are as well. Very interested in the Bitcoin ETF. When that comes out, we'll soon afterwards get options on that. And that'll be a wonderful time to be able to sell against existing positions. Remember the scammers. I'm the black bubble. Ignore everybody else. Thanks all. If you like this as well, hit the bell, like, and subscribe.